Welcome to Objective 1 in Unit 7 of Accounting 3310. We're going to continue this objective discussing the income statement. The income statements separate the ongoing operations of a business from two distinct types of events so that users have a handy subtotal to predict next year's income without irrelevant items. At the bottom of an income statement will be these following items: income before taxes, and then tax expense as the final expense in the income statement. Income before continuing operations is income after taxes, but we call it continuing operations here because there are two separated items that are possible for a company. They may not exist every year, but they may exist at least sometimes. Discontinued operations and extraordinary items are subtracted out after income from continuing operations and before net income, and they are always in this order if both of them are included. Let's talk about discontinued operations first. An operation within a business is an individually managed portion of a business with clearly distinguished operations and cash flows. It could be simply a group of assets, or it could be a segment of the business. An operation is considered discontinued if the operations and cash flows of the component have been or will be eliminated from the ongoing operations. B. The entity will not have any significant continuing involvement in the operations of the component after the disposal transaction. If both of these are true, then the operations are going to be classified as discontinued. Examples of discontinued operations are a business that is discontinuing an unprofitable segment of its business, a company that's discontinuing a product line that's produced in separate facilities and managed separately from the other product lines. A company could be discontinuing operations in one foreign location and will be selling off its facilities and paying to relocate some employees and paying severance on those that don't want to relocate. Each foreign operation is managed separately. When we measure the amount that's recorded into income from discontinued operations, the following items would be included: any income generated by that component during the current year, even the time before it was decided that its operations were discontinued operations. Any gains or losses on disposal of the component that were completed during the current year, and any impairment loss on any assets held for sale from the component. Discontinued operations are also adjusted for the tax consequences of the income that's generated from the discontinued operations. Income from discontinued operations is separately disclosed below income from continuing operations on a net of tax basis. Net of tax means that the income or loss is reduced by the tax associated with the income or loss. For example, with a tax rate of 35%, a gross loss of $1,000 would be decreased by the tax savings from that loss. 35% times 1,000 is 350. If a company had a loss from discontinued operations of $1,000, it would lower the company's tax bill by $350, and the loss from discontinued operations would be listed as $650. If there were a gain of $3,000, for example, then there would be additional taxes to be paid. 35% times 3,000 is 1,050. The discontinued operations gain would be reduced by the amount of additional taxes, and so income from discontinued operations, net of tax, is 1,950. Here's an example of discontinued operations. The Board of Directors has decided to discontinue a segment of the business on July 31st, 2006 by gradually selling its assets as the contracts in this business segment expire over the next 10 months. The income of the segment from January through July 31st is $10,000. The income of the segment from August 1st through December 31st is $6,000. The segment sold equipment with a carrying value of $100,000 for $80,000 during the year. That's a loss of $20,000. In 2007, the company expects income of $25,000 and net loss of another $15,000 on the sale of the remaining equipment. The marginal tax rate for the company is 35%. Which of the above amounts are included in discontinued operations for 2006 and for 2007? First of all, the income before the decision and after the decision are both counted. That's an addition of $16,000. Second, the gain or any loss on sale of assets is included. That's the $20,000. Third, since they anticipate not being able to get the full carrying value for some of the assets, impairment is taken on the assets of $15,000. In total, $16,000 of income minus the loss of $20,000 minus the impairment of $15,000 is a negative $19,000. In 2007, they anticipate income of $25,000. There's no gain or loss on the sale of assets as long as their estimate of the selling price was accurate and the impairment was completely recorded. So, in 2007, there would just be the $25,000 to report as discontinued income from discontinued operations. Now, these numbers are gross numbers, but what's actually reported on the books of the company begins with the income and loss from discontinued operations, but then the taxes associated with these figures reduce the loss and reduce the income. The tax savings on discontinued operations, because the $19,000 loss, is a tax savings of $6,650. So the loss is reduced to being only a loss of $12,350. In a similar manner, the gain, the income from discontinued operations of $25,000 is reduced by the additional taxes that need to be paid of $8,750. Thus, the income from discontinued operations is going to be $16,250 and not the full $25,000. Let's now discuss extraordinary items. If an event meets the following criteria, it is designated an extraordinary item and separated from other items on the income statement and reported after discontinued operations. An event must be both unusual and infrequent. In practice, extraordinary items are very rare. In fact, international accounting standards don't even include the classification of extraordinary. Examples of extraordinary items would include a hurricane in Kansas, in the middle of the United States, far from the ocean. On the other hand, a tornado in Kansas would not be extraordinary at all. Or something like an expropriation of natural gas investments in Canada. This would be an unanticipated event that we would not expect to happen in Canada, even though this sort of thing has happened in other countries. The amount that is recorded as the extraordinary item includes any gains or losses associated with the extraordinary item. It is then decreased for the tax consequences. The disclosure is separately below discontinued operations and on a net of tax basis. We have talked about here two special places that taxes appear on an income statement. They appear as a reduction of discontinued operations and as a reduction of extraordinary items. So what is the number that appears at interest expense. Interest expense for the company as a whole is distributed across really a wide variety of line items in the financial statements. There is tax expense deducted in order to get to income from continuing operations. There's tax expense that's deducted from discontinued operations, tax expense deducted from extraordinary items. And then there are two items that really appear on the statement of retained earnings or in the retained earnings column of the statement of shareholders' equity. If there's a cumulative effect of a change in accounting principle, that is a change directly to retained earnings, or if there's a prior period adjustment due to a restatement because of errors or accounting changes, those items also are recorded net of tax. Here's the principle for tax allocation. Items below income or loss from continuing operations are incremental to the firm's earnings, and their tax consequences are allocated based on the marginal tax rate paid by the firm. The remaining tax after allocating tax to the separately disclosed items represents tax on continuing operations. For example, if we have income from continuing operations before taxes of $12,000, tax expense on that income from continuing operations of $4,000, giving income from continuing operations after tax of $8,000. And then we report a gain on discontinued operations, gross of $20,000, net of tax of $7,000. Resulting in only a $13,000 gain on discontinued operations. When we add the $8,000 and $13,000, we get net income of $21,000. With that disclosure on an income statement, the amount of tax expense is going to be the tax expense on continuing operations plus the tax on discontinued operations. So altogether, this company has $11,000 of tax expense that's been allocated, some to discontinued operations and some to continuing operations. The following adjusting journal entry would be written: tax expense, current tax payable. The $11,000 in taxes need to be allocated to income from continuing operations of $12,000 and income from discontinued operations of $20,000. The allocation process is based on the marginal tax rate. So first we're going to allocate tax at the marginal tax rate to discontinued operations. That's the $20,000 times the 35% equals $7,000. Then we'll allocate the remaining tax to continuing operations. So altogether we had $11,000 in tax expense minus $7,000 allocated to discontinued operations, gives us $4,000 to be allocated to continuing operations. Tax expense on continuing operations isn't necessarily 35% of income from continuing operations because taxable income is not necessarily the same as income from continuing operations. Tax expense is in effect a plug. Whatever is left over after allocating tax expense to discontinued operations, extraordinary items, cumulative effect of a change in accounting principle, and prior period adjustment, that's going to be the number that fits into tax expense on income from continuing operations. All public companies disclose earnings per share on the income statement. It's a required disclosure. There are two types of earnings per share. One is called basic and the second is called diluted. Basic earnings per share is based on the historic earnings that actually happened in the company and the actual number of shares outstanding. Diluted earnings per share is an earnings per share that's based on the lowest possible earnings per share that could exist if all of the holders of potential common shares turned in their securities and obtained common shares, thus increasing the number of shares outstanding. When we talk about the kind of things that could increase the number of shares outstanding, we're talking about some of the securities that we have talked about in this class. Things like convertible bonds are potential common shares. If they were converted, there would be more shares outstanding and earnings per share would be lower. The classifications of earnings per share are: earnings per share must be disclosed on income from continuing operations, on net income, and, if present, on discontinued operations and extraordinary items. Note that diluted earnings per share is the more theoretical earnings per share for economic purposes. Thus, it tends to be used by analysts more often than basic earnings per share. Basic earnings per share is defined as income available for common shareholders divided by average common shares outstanding. Income available for common shareholders is net income adjusted for preferred dividends. Remember that preferred shareholders receive their dividends first before common shareholders can receive any dividends, and so that's taken into account in calculating earnings per share. The denominator of average common shares outstanding includes only those shares in the hands of parties external to the company. That is, treasury stock is not included. Average common shares outstanding uses historical information for income and shares so that it matches the earnings per share based on actual past transactions. Diluted earnings per share is income available for common shareholders divided by average common shares outstanding, with those average common shares outstanding adjusted to include the effect of common stock equivalents, such as convertible preferred stock, convertible bonds, options, and other dilutive securities. This uses pro forma information for income and average shares outstanding so that earnings per share is the lowest earnings per share if all common share equivalents were converted into common shares. Most companies have options outstanding, so a calculation of diluted earnings per share is completed. But diluted earnings per share is only disclosed if it's lower than basic earnings per share. When we look at the income statement, there are some big picture issues that are important to consider. First, the quality of earnings. On the income statement, some earnings are higher quality than others. Earnings from sales to customers are high quality and likely to persist more than earnings from a gain on investment or gains on sales of fixed asset. Earnings and losses that are due to items that are not part of the company's continuing strategy are often identified as special items inside of income from continuing operations, and it's management discretion whether they designate those items and point them out as being items that are different and not to be repeated. Companies may use earnings management to alter an individual year's earnings. Companies use their judgment and can adjust the actual timing of business events or engage in business events solely because of their income statement effect. You can imagine a company that puts on an extra shift in December just to make sure that deliveries take place before the end of the year in order to pump up their earnings. Even though that didn't actually increase their orders, it just helped them to get those orders out sooner. Another way in which companies may manage their earnings is by adjusting their assumptions used in accruals and deferrals to the highest or lowest reasonable assumptions. That is, the company may make deliberate estimates of bad debt expense that are really the lowest possible bad debt expense figures that anybody could possibly justify, and thus they're going to pump up their net income number. This bias in the accruals and deferrals may be simply a judgment of the executives, but occasionally it can bleed over into being so biased that it's actually an error and represents fraud. Another income statement issue is the format of the income statement. Within industries, much of the presentation of income statements from company to company are similar. However, across industries, there are often differences related to the productive activities of the company. There's currently a Financial Accounting Standards Board project on financial statement preparation that's been postponed at the exposure draft stage and really hasn't been acted upon. But there is some indication that the Financial Accounting Standards Board is likely to provide more standardization and structure to the reporting of income in the future. This is the end of our discussion of the income statement.